Well, hi guys, welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. It's a Wednesday morning. Looks like we are in for some midweek blues, given the fact that the global cues are looking fairly subdued this morning. The GIFT Nifty as well, hinting at a negative start for the Indian market. Lots of stocks to watch out for today, including the likes of UltraTech Cement. You also have the likes of NALCO. Z as well, JSW Energy, the QIP has opened up. So lots of stocks in focus this morning. Of course, the Bharti Hexacom's, 4,000 crore rupee IPO as well opens up for subscription today. We'll be talking about that as well. And of course, we'll also be taking up all your stock related queries with our technical experts on the show. So if you have any queries, keep them coming in on our live feed on YouTube. We'll try and take them up. And we'll also be getting you a big voice on the show later, post-market open. So stay tuned for that as well. But of course, lots lined up as I mentioned. But before we go any further, let's take a look at the top headlines at this hour. Wall Street ends lower, for a second straight day as Treasury yields hit highest level since November on rising geopolitical tensions. In fact, the outlook on Fed's interest rate cut timeline has also remains uncertain. In fact, Asia also opens lower on a weak handover from Wall Street. The GIFT Nifty, as I mentioned, is hinting at a weak start for the Indian market. Crude rises to a 5-month high with Brent around that $89 a barrel mark. Prices rise amid supply concerns and escalating tensions between Israel and Iran. Meanwhile, gold's record run continues as safe haven buying propels the yellow metal above the $2,300 an ounce mark. RBI's Monetary Policy Committee meeting begins today. In fact, the central bank is likely to keep interest rates steady. No change expected in stance as well. However, FY25 growth forecast may be revised higher. And a powerful earthquake measuring 7.2 on the Richter scale rocks Taiwan, collapsing buildings and creating a tsunami. Japan too issues tsunami warning for Okinawa. Well, on that note, let's take a look at the cues for trade this morning. If you see how the Nifty shut shop yesterday, we were extremely flat and we ended with a negative bias. 22,453 is where we ended, just about down somewhere around 9 points or thereabouts. But important to note that the India VIX index closed below that 12 level, easing further by nearly 4%. In fact, even day before yesterday, we saw a cool off of 5% or thereabouts on the India VIX index. The mid and small cap indices, continue to outperform the benchmark. So both the Nifty mid and small cap indices ended higher by about 1% or thereabouts. Talking about the F&O Qs, the Nifty open interest was up 1.6%, added 1.5 lakh shares. The April futures are trading at a premium of 124 points vis-a-vis a premium of 141 points. The Nifty Bank open interest was up 2.8%. It added somewhere around 52,980 shares or thereabouts. If you look at the put call ratio, that's come down to 1 vis-a-vis 1.07. And, looking at stocks that will be in F&O ban, Hindustan Copper, that's the stock which is new in the F&O ban. Of course, fund flows picture, FII's net sold shares worth 1,600 crore rupees in the cash market, whereas DIIs continue to be net buyers and they bought shares, to the tune of nearly 2,000 crore rupees in the cash market. But, on that note, let me bring on board our technical expert for today. Joining me is Rajesh Palviya, who's the Senior VP Research Head Technical and Derivatives at Axis Securities. Great to have you on the show, Rajesh. We have been fairly, iffy yesterday. We ended with a negative bias today as well. The GIFT Nifty is hinting at a negative start. Do you foresee some bit of consolidation at these levels, perhaps this week, given the fact that we have the RBI policy outcome as well on Friday? Would you say that the bulls will tread with caution, and what are the support levels that you're watching out for both on the Nifty and Nifty Bank indices?
Good morning, Nandita. Yeah, so caution is already visible on the charts itself. If you look at the daily chart for Nifty, this is the second consecutive day where Nifty has formed a doji candlestick formation. That is a clear sign of indecisiveness. So Nifty is slightly shying to, again, scale up to all-time high trajectory. Maybe some couple of days we can see some consolidation as RBI event is lined up. So maybe some positions are, taking place to play this event. Looking at the call concentration, the major writers are placed their position at 22,500. So that level needs to watch on Nifty spot closely. If we are able to take out those levels, then there would be short covering action in Nifty going forward. But till the time Nifty not crosses these level, some bit of consolidation we could see. On the downside, 22,300 is having major put based concentration, so that is likely to act as a good support area in this decline. But overall structure for Nifty is bullish, and we believe that sooner or later we are going to have all-time high trajectory for Nifty and possible breakout. We could see in very short period of time in Nifty going forward. So buy on dip should be your strategy at this moment. If you, as indicative ticks are indicating that around 100-point cut we could see in Nifty in opening. So that would again give you opportunity to buy in this decline. We are initiating here to buy 22,350 call option, which was closed at around 149 in previous day. So if in this gap down, you would get opportunity to buy this call option at lower price around 120 to 115. So you can buy around those level with stop loss of 85. On the higher side, again, we are projecting target of 175 to 185 for this call option. So buy on dips is the clear strategy for Nifty. For Bank Nifty, 47,200 is the immediate support area for Bank Nifty spot. If we hold those level again, some support buying action we could see in banking stocks again in the decline. So again, for Bank Nifty also, structure is still bullish. For spot 47,800 is the major call concentration area. If we able to cross those level, then this short covering action can be there, and the possible target on the higher side we could see towards 48,000, 48,200 on the Bank Nifty also. So both indices are looking promising. Buy on dip should be your strategy at this moment.
All right, buy on dip strategy should be the strategy in fact going forward. But I also want to get in your thoughts, Rajesh, on NSE's move to reduce the lot size for Nifty derivative contracts, right? How are you viewing this move, and what would be the implications of this on F&O traders?
So almost contract value reached to around 9.9 lakh to 10 lakh for Nifty, and so I think this is a regular feature of exchanges. Whenever the contract value reach to higher level, then they always try to reduce that contract value. That will again yes, there would be some hit immediately on volume or turnover for Nifty as well as for Bank Nifty, as contract value has been reduced. But again, this will give again, comfort, because, again, when you are buying one lot of Nifty, there is a high risk. Those who are retail traders, there is always a high risk as the contract value is higher. So again, it would give comfort to the retail clients when you have a lower contract value. So volatility would be reduced for some time. And maybe again, going forward, again, the volume will pick up, because as the traders are very much active in the index trading in last couple of years. So I think that is again pick up in coming time. But at this moment, for some time, there would be less volatility in the market.
All right, that's the view then. But very quickly, as we step into the market open, what would your stock recommendations be for the day, Rajesh?
So I think defense stocks are doing good. HAL is our preferred pick, as stock almost closed near to its all-time high trajectory. And looking at the overall structure, HL, BL, both stocks are looking promising. So we prefer to go with HL here. And we are projecting target for HL on the higher side towards 3,600 to 3,650. So if you get opportunity to buy around 35.10, 35.15, so it's again, opportunity to buy HL with stop loss of 34.85. The second stock that we like is from hotel industry, that is Indian Hotel. Very strong buying action in last couple of trading session. Stock almost trading near to its all-time high trajectory. So we expect that Indian Hotel may exhibit further more upside. Possible target we could see towards 625 to 635. So one can look to buy this stock with stop loss of 595. And the third stock that we like is from metal space, that is SAIL, Steel Authority of India. After a long consolidation, now stock managed to be a breakout of its previous swing high of March series, and looking at overall buying interest across metal space, we believe that SAIL may continue furthermore upside. So keep your stop loss at around 143. On the higher side, we can see target towards 160, 165.
Right, those were the stocks on Rajesh's radar for today. But let me also bring on board the big voice that we promised you at the start of the show. Joining me is Ashish Somaiyaa, who's the CEO of WhiteOak Capital AMC. Great to have you on the show, Ashish. As we can see, the global cues have turned a bit unfavorable, right? US yields have surged. Crude has once again, surged near that $90 a barrel mark. Of course, the rate cut bets, the June rate cut bets have also receded when it comes to the Federal Reserve, right? Given all these factors, do you think, it would slam the brake on the current leg of rally, or do you think the market will still go ahead and see a pre-poll, a new leg of pre-poll rally?
Yeah, hi. Thanks for having me. I think that, in my personal opinion, it's just become a bit kind of fashionable to say that election results are fully discounted and that budgets are like a non-event, etc., etc. But if you go by all the pronouncements that's coming from the leadership and from the highest of authority, I think that we should not be taking the election, the run-up to the election results, and the upcoming full budget. I don't think we should be taking it lightly. In short, I would say that there is something to look forward to, and markets always look forward to events, and markets are always full of expectations about what may or may not come through an event. So from that perspective, I think that market has been in a particular range for a long time. If you see, for example, just go 6 months back till about October 23, and then you compare that with October 21, you will find that that entire period of 2 years, market was languishing between 18,500, 19,000, again 18,000, sometimes 16,700, sometimes 17,700. So market was range bound. Of course, there was sector rotation. Sometimes large cap did well, sometimes small cap did well. Sometimes, financials, IT, etc. did well. And then later after the war, PSUs and metals and commodities and energy, etc. Did well. So there was sector rotation, but for a couple of years, market was flatlining. And at that time, the concerns were about geopolitics, the concerns were about US policy, and the concerns were about India's political landscape. But if you see, no escalation, thankfully, in geopolitics. India's political landscape became a lot more clearer. US policy, while everybody is waiting for a rate cut, at least they announced a pause, correct? So in the last 6 months, a lot has changed. Our fundamentals have accelerated, actually. But if you really ask me, I think people have been people are just taking the market for granted. My sense is there is significant upside in the next few months.
All right, expect significant upside in the next few months. Hold that thought, Ashish. We'll come back and talk to you about various sectors as well. But just take a look at the market open. We've opened in the negative zone, as I mentioned. The GIFT Nifty was also hinting at a negative start. So just about 0.5% kind of a downtick coming in, almost 100-point cut on the Nifty. Even the mid and small cap indices have succumbed to selling pressure today. 0.5% cut coming in on the Nifty Midcap index. And but if you look at the market breadth, the BSE advanced decline ratio is in favor of gainers. So, the breadth is fairly okayish, but the Nifty small cap index is trading in the green as we speak. Most of the sectors are trading in the red, including the Nifty Bank index. That, by the way, is holding on to that 47,000 level as of now. Let's just quickly take a look at the gainers and losers then. UltraTech Cement, top gainer on the index in a weakish market, given the fact that it has seen capacity expansion beyond 150 million tons. ONGC, Axis Bank, Divi's Lab, Tech Mahindra, Hero Motor, some of the other gainers. And Apollo Hospitals, Bharti Airtel, Britannia, Nestle. So some of the consumer names are once again under pressure. And even Bajaj Auto has come under a fair bit of selling pressure. Yesterday, remember, the stock had hit a fresh high. So all in all, a weak start for the market. We'll have to see whether or not the weakness persists, or we will be able to, snap out of this losing trend in the second half of the session. But Ashish, talking to you about the broader end of the markets, of course, we saw some bit of correction creep in when it comes to the mid and small cap indices, right, after the SEBI diktat. But, they have staged a good rebound if you look at the last 2 weeks or so. But do you think there's some bit of froth that still needs to get cleared, or do you think the correction phase that we saw is out of the way for now?
Yeah, I think market will always work on relative value. As long as the underlying, the economic conditions, and as long as the underlying feel is bullish, there would be an uptrend. Now, in that journey, it's very normal that at certain points in time, certain sectors will do well, certain market caps will do well. And then some of those, when they get stretched, people will look for where is relative value. Now, in fact, I'll give you an example. Just a month and a half back, I read a report from one of the leading brokerage houses which said that now there is value in quality. It just suggests that market is probably, I'm not trying to say that I necessarily subscribe to any such view. I'm just trying to tell you as an example that, it just suggests that market tends to rotate from something which gets expensive in favor of something which might look relatively attractive. So as long as there is no breakdown, as long as there is no change in sentiment, as long as there is no change in economic conditions, I think this bullishness would persist. And from time to time, you would see. So for example, if you take the month of March, I think small cap index was down, but BSE 500 in totality was flat, which actually suggests that large caps outperformed small cap. So that kind of, even the color of money, for example, last few months, market has been, seeing flows from retail and HNI and domestic mutual funds. On the other hand, like you were just mentioning about US policy, a month, couple of months, a quarter down the line, if there is any pivot in US policy, you might see that the color of money might change and FIIs might actually turn positive. So that would also change what works in markets. I think as long as there is a bullish trend, we should all be constructive. At different points in time, different market caps or different sectors will take the lead.
Since large caps have just about started outperforming, would you advise investors to rotate out of mid cap funds and increase exposure to large cap funds? Should that be the strategy now?
So, I'd just like to clarify one thing. Whenever we say, whether it is you or me or say the powers that be, the regulator, when anybody says that small and mid caps have become expensive, what I find is that the guy on the street, our friends, investors, they generally start assuming that, okay, all these guys are talking about a crash in small cap or mid cap. I don't think anybody is predicting a crash in small cap or mid cap. I think the case is being made only for, like I said, relative performance. So with that caveat, I would like to clarify that yes, one does expect that large caps in the next 6 months, large caps should outperform small and mid caps. But that message is only to the extent of an outperformance, which means that it should be something like the month of March. In the month of March, I'm repeating, but that's exactly what happened in the month of March. Small cap index was down, but BSE 500 in totality was flat, which means that large cap actually would have outperformed, right? So that's the kind of expectation going forward. I don't think that small and mid cap is going to crash or give a big negative return, but it could just lag large caps. And hence everybody needs to, frankly, people who are long-term investors, they should not be changing their allocation with what someone communicates as 6-month view. But yes, anybody who's kind of on the ball and managing things actively, they should at least look to ensure that they are not too underweight large cap or too overly exposed to small cap. Definitely your exposure should tilt more in favor of large caps at this point in time, because relative value is what will always rule the markets.
Right. I also want to talk to you about pockets that have seen a fair bit of outperformance, like the defense PSUs, for example. They have run up quite a bit. And yesterday there was a report from a global brokerage where, they mentioned that they see another 45 to 40% kind of an upside on some stocks in the defense space. Of course, lots of factors at play, government's push on self-reliance and, to push to boost exports as well. Would you subscribe to that view that there is still a fair bit of upside in some of these defense PSUs that have already seen quite a bit of a run up?
I think, if I were to actually just kind of second guess these kind of pronouncements, it's coming partly from two things. One, I think, look, in the last 2 to 3 years, defense as a, buzzword has been top of mind because of geopolitics. On top of that, obviously, for the right reasons, our government is looking to indigenize and invite investments. And the third and most appreciable thing is that the way we are managing the public sector enterprises is that in the past, for public sector enterprises, the buzzword was disinvestment and later privatization even. But today, thankfully, the government is using state-owned enterprises more as an instrument of policy action and more as an instrument of driving investment in the economy. So clearly, that has become constructive, right? And also, if somebody is saying that public sector enterprises and defense would be in play, I would not disagree. That is also partly you should be mindful that if there is an election coming up and then there is, the powers that be are suggesting that, it's supposed to be a big bang budget which plans for the next 25 years. Then who are we to take it lightly or take it for granted? So that's why I said right at the onset, there is something to look forward to. Of course, I'll also give keeping, it's always important to have a balanced perspective. So I would also warn investors that please keep in mind when something becomes a theme or a buzzword, then you better be careful. So go stock specific, go bottom up, but be constructive on the market. That's what I would say. And also, as far as PSUs or state-owned enterprises are concerned, they are across sectors. So there also, you should go bottom up and be mindful of something which just becomes like a buzzword.
What about realty? It was the best performing sector of FY24. How would you advise investors to, invest in this particular sector through stocks, perhaps through REITs, or would you say real estate, like, buying into real estate? How would you really approach this space?
See, I have always been a believer in real estate. I personally also ensure that my portfolio has real estate as well as equity. I don't invest in fixed income because I call myself an aggressive investor. What I've seen is that in the last 10 years, it's become very fashionable to pan real estate. That's probably because in the decade before this decade, there were a lot of structural changes. I think there was governance issues with some of the leading real estate companies. There was restructuring as far as the economy itself is concerned. Banks had NPA problems, right? So multiple challenges played out from 2011-12 right up to 2020-21, and it culminated with COVID. I think you should leave aside all those structural issues. And people who are listening to you and me here are probably believers in the economy, believers in the equity markets. And I would just say that if you're a believer in the economy and if you're a believer in corporate expansion, then you cannot be bearish on real estate. So my sense is that real estate is a long-term growth potential. Now, of course, you would go stock specific, right? REITs are a great instrument because they are a fantastic hybrid. But for that, you need to have a deeper understanding of the underlying asset class, whether it is commercial, whether it is ports and highways and infrastructure, or what exactly it is. You need an understanding of the underlying asset class, and you need an understanding of the usage and occupancy and all of those kinds of. You need to take a view on all of those things. If you're buying commercial real estate backed REITs, then you should have a sense of which way occupancies and which way projects are going and which way interest rates and yields are going. So while real estate investment trusts are a great instrument, but they should not be just assumed to be quasi-debt. They are hybrid instruments, and just like equity needs analysis, REITs also need analysis. But all in all, I would say that I would be constructive and, again, not get caught by what has been popular belief in the last decade.
A couple of more questions, Ashish. I know you're not a very big fan of debt funds, since you mentioned that you don't really believe in fixed income investing. But given the fact that we've had the Indian bond indices inclusion in JP Morgan index and even the Bloomberg emerging market index, there is expected to be a gush of liquidity in the bond market, right? So should one still look at some bit of exposure to debt funds in their portfolio, and how much should one look at? What proportion of their portfolio should be a part of this particular debt funds?
Yes, so by no means I meant to say that people should not be investing in fixed income. I think it's a must-have in most portfolios. Correct? When I was speaking for myself, I meant I would keep some fixed income only for emergency and not as a long-term investment. But clearly, there are conservative investors, and there are people who do not want to expose themselves to the high volatility of equity markets. And then, of course, there are people who have some goals or objectives to be met just around the corner, maybe in the next year or 2 years. So they would always have fixed income in their portfolios. Now, talking about the here and now, yes, for the last few months, especially after the pause in US monetary policy and rate hikes, one has been expecting that there will be a pivot in US policy. I think that is one thing to watch for, because the moment there is a pivot in US policy, that would release the pressure on our currency and release the pressure on our external macro. And that would also reduce the pressure for us to hold rates high, irrespective of what the demand for our economic growth may be. So to the extent that our policy is dictated by external environment, I think a pivot in US policy is something to watch for, because that would probably result in some, driving down of rates and hence appreciation in bond portfolios. The second one, clearly, already you can see that just by the buying action, in anticipation of inclusion in the bond index, you can see that foreign investment in bonds in India is actually rising. So that is another driver. So my sense is, yes, next 12 to 18 months, there is potential for appreciation. From time to time, the secondary market is already showing that. So one should consider having longer duration in the portfolios, at least with a 12 to 18 month time horizon.
Lastly, what about gold? Of course, it has been hitting fresh highs. At least in the international market, it has crossed that $2,300 per ounce mark. Do you think, this is the right time to buy gold, or do you think it's become fairly expensive? How should really one approach the yellow metal pack now?
The two things to look at, even if you are an equity investor, like I mentioned, that there are a lot of people, for most people actually, having fixed income in the portfolio, preparing for some emergency, preparing for goals around the corner. So asset allocation is very important. You must have the equity fixed income. Now coming to gold, clearly, if you are somebody who has a lot of exposure to equity, every once in a while, equity markets go through their own challenges. Once in 5 to 10 years, the market makes you believe that the world will come to an end. And at all of those times, gold is your savior, because on the downside, it cuts volatility in the portfolio. When equity is losing a lot of value, gold definitely tends to, in an asset allocated portfolio, gold has a great role to play of cutting volatility on the downside. So that is one driver of why you should have gold in the portfolio. Second is also related to what you said. If you see some of the signals from the US economy, right? Like, for example, commercial real estate, a collapse in real estate prices, some of those kind of indicators, which probably people believe that while the economic numbers are coming strong around the corner, there is weakness in the US economy. So if there is weakness in the US economy, if there is going to be weakness in the dollar, that is another reason, at least internationally, to believe that gold prices would appreciate. Of course, some of that gets counterbalanced because our currency appreciates. But fundamentally, if you look at it, gold should find a place in people's portfolios. In fact, last year also, gold appreciated and gave double-digit return. While it's making new highs, I still think that for a conservative investor, it is a must-have in the portfolio so that it cuts volatility on the downside. The last thing I would say is that if you're going to make an asset allocated portfolio and if you're using gold to cut volatility, then make sure that gold has a reasonable, 20% kind of exposure in the portfolio. Because if you have, say, 50% or 60% in equity and 5% in gold, it doesn't do anything to reduce volatility, right? So if you are going to make an asset allocated portfolio, if you are conservative, if you want to reduce volatility, then about 20% exposure to gold is a must for any retail investor.
All right, 20% exposure to gold, is a must for conservative investors. With that, Ashish, appreciate your taking out time and joining in this morning and sharing your thoughts with us. Look forward to, chatting up with you once again sometime soon.
Thank you. Thanks for inviting me.
Thank you. Well, with that, let's go back to our technical analyst who's been waiting by. Rajesh, want to get in your thoughts on an UltraTech Cement. The stock is doing well in a weakish market, but if you look at the YTD chart, it's still got a lot of catch up to do, right? It's been one of the underperformers, so to say. On a YTD basis, it's down somewhere around 3% or thereabouts. But here on, what are the charts signaling? Do you see some more upside and perhaps, some bit of an up move over the next couple of weeks?
So overall structure is bullish for UltraTech Cement, though there is some profit taking at higher level. But still, if we analyze the weekly setup, stock managed to give breakout of its falling channel on a weekly chart. So that clearly shows that this uptrend can continue further. As we are seeing on the short to medium term perspective, till stock is holding above 9,700, 9,800 kind of zone, trend is likely to remain on the bullish side for UltraTech Cement. Once stock manages to cross about 10,650 kind of level, 10,400 kind of level, then possibly this really can extend further, and we could see target towards 11,000 also for short to medium term perspective. So buy on dip should be your strategy for UltraTech Cement. If you get any opportunity towards 10,000 level, it's a good level again to re-enter for trading perspective. Keep your stop loss around 9,900. Again, we expect a pullback action could trigger around 10,000 mark for the UltraTech Cement, and possible target we can see towards 10,250 to 10,400.
All right, those are the levels to watch out for on an UltraTech Cement. But with that, let me also bring on board another technical analyst who's joining in right now, Osho Krishan of Angel One, with us. Thanks a lot for joining in, Osho. We've had a negative open. Of course, we've broken below that 22,400 mark for the day. What is the crucial support level that you would watch out for on the index? And the Nifty Bank Index also, it's down somewhere around 0.5% or thereabouts. 47,000 crucial level here.
Very good morning, Nandita. First of all, if I have to say about the benchmark index, then the undertone remains bullish. It's just the side effects or repercussions of the negative global cues that we have seen a gap down opening in the benchmark index. But overall, the undertone is still in the favor of bulls. So I'm expecting that for Nifty 22,300 on spot levels is a very strong support zone, because even on the derivative fronts, 22,300 has strong put writers positions at the strike prices. So I'm expecting there can be some kind of consolidation that can be seen around 350, 320 spot levels. Once we sustain around these levels, then we can see some kind of buying traction in the benchmark index. Now coming to Bank Nifty has a very strong support zone of 47,200, which was previously acting as a very stiff resistance. So now any dip towards 47,200, 250 odd levels should be acting as a very strong support zone, and one should look for opportunities to buy in both the indices on the dips. So overall, the undertone remains bullish. There can be some stock specific action and even thematic movers that can be seen for the day. So one should have to be very fuzzy with his stock selection, because we are not expecting a very strong breakout in the indices in near period. So there can be a range bound or consolidation that can happen in both the key indices. But overall, the broader market looks very lucrative as of now, and one should have the perspective of stock specific actions.
All right, be stock specific. That's the advice then. But let's shift focus to some viewer queries that are trickling in this morning. To you, Rajesh, NALCO, this stock has had a fairly good run, shining bright over the last 5 sessions. It has, given double-digit returns. We have a couple of people writing in and want to know your thoughts on a NALCO. Pooja Khanna and Rakesh, they would like to know your advice on this particular stock. Rakesh particularly wants to know if it warrants a fresh entry at the current level. What would you say?
Yeah, so definitely a very strong momentum is going on in most of the metal stocks, and NALCO is one of the stock managed to give breakout of its previous swing high. Long built up is there in today's session also. Looking at the overall structure, we believe that this rally can extend further. So even at the current market price also they can buy, as the fresh breakout is already there on the daily as well as on the weekly chart. Keep your stop loss at around 171 for trading perspective. On the high side, we can see target towards 182 to 185 for NALCO in the continuation of this up move.
All right, that's the view on NALCO then. I hope that answers your query. But the next query I want to take up is on IREDA. Ashutosh Namdev wants to know that, he has IREDA shares at an average price of 115 rupees per share, but he wants to know whether he should hold it, and if yes, for how long. Rajesh, what would you advise him to do, even though IREDA is a new listing?
Yeah, so new listing, and since last 2-3 trading session, again we are seeing that stock is hitting all upper circuit, and again in today's session also there is a upper circuit of 5% for IREDA. So I think you should hold. Stock has corrected significantly in last couple of weeks, and again stock has formed a bottom at around 125, and the recovery is taking place in the stock prices now. Stock managed to view breakout of last 3-week consolidation range in this pullback. So I think there could be another upside. We could see towards 175 to 180 in the continuation of this up move. Keep your stop loss at around 145. Hold your position. We believe that 180 could be the possible target in the continuation of this trade.
Right, that's the view on IREDA. But coming to you, Osho, we have a query on Hinduja Global Solutions from Chirag Hadilal. Looking at the charts, what are the signals you're getting, and if somebody already has a position in this particular stock, should they hold on to it or should they exit?
See, overall, this counter is into a corrective phase. It is basically into a downtrend, and it is hovering below the previous swing low, which was approximately around the zone of 820, 825. So until it surpasses the same levels again, we are having a bearish view in this counter. But looking at the recent development in the last couple of trading sessions, there can be some kind of a movement for short-term basis, but 825, 830 remains a very strong resistance zone for the time being. So one should better wait for those corrections to get surpassed. If it happens, then we can see a surge towards the zone of 900. If not, then again it can retest the zone of 740. So if you are holding a position, keep a structured stop loss of 740 and hold for the time being.
All right, that's the view. Hold for the time being. Let's talk about some of the defense names once again then. We have a query coming in from Satvika and she wants to know your thoughts on an MTAR Tech. This stock has had a fairly good run in the last 5 days, up 12%. Although over the last 1 month it hasn't really given great returns or so, but of course we know that defense stocks had cooled off a bit after a stupendous rally, but now that rally has resumed. For MTAR Tech in particular, Rajesh, what are the levels you're spotting here?
So we have seen almost a corrective move of last 5-6 months, and in this current month there is a reversal is taking place. The stock took support almost from its multi-month support area of around 1700 kind of zone. So looking at the longer term structure, we believe that if stocks holds above 1700 level now, then some pullback action towards 2000 level could be there in this stock, as most of the again defense stocks are showing good traction in terms of buying. So we believe if you are already in trade, if you have bought at lower level, your stop loss now should be placed at around 1820. Hold your position. A possible target in this pullback we could see towards 2000 level.
All right, expect levels of 2000 on an MTAR Tech. But Osho, we have another query from the defense pack. This one is on Bharat Electronics. Coming in from Ankit, wants to know your advice here. But the stock has already hit a 52-week high, has been a high flyer in the defense pack. So here, what are the levels on the upside that one should keep in mind?
See, overall, defense counter are looking very positive for the time being, and all major of the defense counter are hitting 52-week high. So I'm expecting that the rally should continue in the coming period. From short or even from medium term perspective, the chart structure looks very promising. For BEL specifically, it has given a breakout around the zone of 215, 210 odd levels. So I'm expecting from here onwards, there can be another set of 25 to 30 odd points of rally that can be seen. So approximately 240, 45 can be seen from medium term perspective. While on the downside, we are having a very strong support base near the zone of 200, 205. So in future, even if there will be any kind of profit booking or correction that can happen, so one can definitely try to accumulate it near the zone of 200, 205.
All right, just about a couple of more queries then. The last one, so to say, Vikram Mehra wants to know your thoughts on a Maruti. The stock over the last 5 sessions has been fairly quiet, but in the last 1 month, it has given returns of somewhere around 8% or thereabouts. For a Maruti, do you spot any trade here, or do you think Tata Motors is better on the charts?
See, for Maruti, yes, the counter looks very strong. It has given a very strong rally, but currently it has tested the overbought territory. So there can be some time-wise correction or profit booking that can trigger in this counter. But overall, the structure remains positive. Even if there will be any kind of dip towards 12,000 odd levels, that should be triggering fresh accumulation in this counter. So for the time being, one should better wait for some kind of profit booking in Maruti. For Tata Motors, yes, Tata Motors looks more promising to me, and I'm expecting that it has the potential to reach 1050 on immediate basis, followed by 1100 in short-term period.
All right, Rajesh, last query to you. This one is on a Suzlon. In the last 5 sessions, we've seen good traction on a Suzlon. Would you advise an entry?
I think in this pullback, yes, stock is now trading about to 20-day moving average. So near-term chart is showing strength. Yes, one can buy Suzlon at this level with stop loss of 40 rupees. Upside target we can see towards 46 to 48.
All right, Suzlon. With that, I think we've come to the end of the query segment. But gentlemen, Rajesh and Osho, thanks a lot for taking out time and joining in this morning and sharing your thoughts with us, and also helping our viewers navigate their trades for the day as well as for the long to medium term. Look forward to interacting with you guys sometime soon.
Thank you.
Well, let's also talk about some of the buzz on the IPO street. Then Bharti Hexacom IPO has opened up for subscription. In fact, this is the first IPO from the Bharti Group after Bharti Infratel back in 2012. In fact, it's a 4,275 crore rupee IPO, and it will close on the 5th of this month. In fact, the price band has been set at 542 to 570 rupees per share. It's purely an offer for sale by the telecommunications consultants of India, and it will be diluting somewhere around 1,500% shareholding via an IPO. In fact, the company has raised somewhere around 1924 crore rupees through its anchor book. Capital Group, Fidelity, BlackRock, Adia are some of the anchor investors. So, watch out for this one. Whether or not you should subscribe to this one or not, find out by logging on to moneycontrol.com and understanding what experts have to say about this particular IPO. We also have a new listing coming up at 10 a.m. SRM Contractors. This will be listing on the bourses, and if the grey market premium is anything to go by, it is expected to have a robust debut at a premium of 40% to its issue price. In fact, the issue was subscribed nearly 86 times the shares on offer. Well, with that, I think we're completely timed out on this edition of Opening Bell. The markets are, of course, looking subdued below that 22,400 mark. In fact, even the Midcap index is trading in the red today, and the Nifty Bank index down by about 0.5% or thereabouts. Although, if you look at the breadth, the advanced decline ratio is in favor of gainers. So let's see how the day really pans out for the market and whether or not we manage to stage a recovery in the second half of the session. But you'll find out when you come back and join us on Closing Bell at 3:30 p.m. But for now, it's a goodbye from me and the entire team. Thanks a lot for watching.